The next essential skill is deal messaging, effectively deal marketing. Think about it. Of all the different investment vehicles, only syndicates have to do deal level marketing. Angel investors don't have to do it. They're investing on their own account. Funds market the whole deal and the proposition. Only syndicates have to do deal by deal marketing. If you have worked with startups, maybe have been a founder yourself, you'll realize that knowing how to market your company in a good way is actually remarkably difficult. If you've seen pitches and outreaches from other founders, you realize that the messaging is all over the map. And I don't say that in a disparaging way for founders, right? It's just they're unfamiliar with the craft. And intuitively, we all know when we look at a pitch that, hey, there's good and bad versions, right? So the question now becomes, what does good look like? And so this is the point of this section. I'm going to give some examples. I've obfuscated the company names as much as possible out of respect to the founders. And to be clear, this exercise is not to disparage anyone or to call anyone out, but this is just to illustrate the point of what good deal marketing looks like. This is an example of a company that I got from a deal platform. I have no prior relationship with the founder. I don't know about their company. And the first touch point is this. I get a wall of text that looks like a Wikipedia page. Way too much commitment you're asking from me to get engaged on this, right? It doesn't work. Another example, we get what looks to be a deal page. The headline kind of tells me what the company does, but not really. It's like virtual power plant SaaS for smart grid. I get it, but again, not necessarily. There is links to resources like a recording and a pitch deck. And then again, wall of text and way too much friction. Example number 3, don't know this company. You have a headline here that is deliberately provocative. That is the intent, but also overselling. You're opening up with, opportunity in $500 billion market. And this whole thing is just hyper vague and just filled with a lot of things that are just overselling. So immediately, these things, it doesn't work for me either. And I think if you took the time to look through this, you'll get the point that I'm making. So what does good look like? I think that investors have a certain style of communicating. So we really need to put ourselves in the lens, the psychology of investors again, it's like learning a language. So some basic guidelines on communicating with investors. Number 1 is exercise editorial control. You have one chance to shape how investors think of a startup. So frame the narrative. Think about it with a clean slate, how you want to position this startup to investors. It's deceptively difficult, I will tell you that. You need to challenge yourself to buck the existing thinking because as we've seen, the startup's positioning on how they describe themselves might not be the best framing for it. And very often it is not. And this is actually harder than it seems. You want to streamline and optimize as much as possible. Get investors to the aha light bulb moment as quickly as possible, which means drop the jargon, stick to very clear, succinct language. Use as few words as possible without losing key points and fidelity in your message. When I send out my newsletter, when I announce a deal, I draft something up in my email automation. I send it to myself and I look over this and I'm literally cutting down words and letters in a bid to remove as much friction as possible, get to the point in 30 seconds. You want to preserve investor trust. Represent the deal fairly. So the language that you use, being neutral, fact-based, showing data, these things help you look neutral. If any of you want examples of this, reach out. I'm very happy to show you how I do it. You are effectively staking your reputation on this deal. Okay, so you don't want to cross as overselling. You want to be able to stand behind the deal with conviction. Ultimately, don't oversell. If you hype it up too much, it's going to burn you. Let investors engage on their own. This is going to be the cleanest signal of interest you can get from your investor network. The best way you can de-risk the execution, honestly, is go back. First principles, build your investor trust, build your investor network in terms of size, maintain their trust, and know your metrics so that you can de-risk the execution on the fundraise. And lastly, think like deal marketing, like fishing. When we publish a deal, the goal is not to get capital commitments on the first touch point. We're simply establishing understanding and nurturing interest, and nurturing interest as we go along in the process. So oversharing information at the start is a big mistake. You cannot expect investors to invest significant time and energy on something before they know even what this company does. Your goal when you publish a deal during this marketing process is to land a hook, not to close capital. Remember that. After looking at whatever you say about this deal, your first touch point, investors should have questions. And that's a good thing because when they have questions, it's a sign of engagement, right? It's actually somebody saying, hey, this is interesting. I would actually like to learn more. And this gives you a way to nurture that interest and lead them to the data room to educate them on this deal, right? So this is the process. I'll leave you with this. Very actionable. This is my framework for sharing a deal with investors in an async forum. Async means not pitching a deal live. All you get to do is send an email and in a very time, bandwidth, and context constrained forum, communicate the deal and maximize interest. So I call this my 10-line copy template. And this is the format. I break this down into a few parts. The level 1 message is the identity statement, and I always include a URL, right? This is a call to action. Usually it's a link to a website or a pitch deck. Effectively here in one or two lines, I want investors to read this and understand what the company does and make it super easy to understand. The level 2 message is what I call the hook. Say something interesting about this company. What makes them compelling to you? Describe that. Is the founder a rock star? Do they have an amazing patent portfolio? Do they have some unique advantage that nobody else has? Level 3 is quantification. Show some numbers because numbers back up the argument. Show some numbers that will back up your claims. So whatever your hook is, show some numbers that support this. So your hook might be, this company is growing super fast. They actually grew 20% month over month for the last 3 months. Then you show the numbers here. And therefore their ARR is this, for example. And level 4 is a bucket I call everything else investors look for. It's subjective. There's some room to play here. For me is market size. So I know that this company can be $1 billion company. The business model, how do they make money? What are their economics? Traction really matters. What is the growth? How many customers they have and so on. The terms of the round, I will add other notes in case there's something notable. For example, hey, this is a serial founder. He's had a prior exit. And then closing off with a call to action, which is providing resources like the data room or the pitch deck. So this is my framework. Take it, try to apply it. Strip down all the friction, get to the essence. You want investors to spend 30 seconds on this and get it. How do I know this works? In the programs that I teach, I do an exercise with the investors. I tell them, put yourself in the position of a syndicate lead. You have found a deal, you've done the diligence, it checks out, you are going to go to market, and you are going to write that 10 lines of copy in one slide. And the exercise that we go through is I give everybody one slide to write that, and all the other participants are going to read that slide and evaluate it. Okay, you don't get to pitch. You do not get to talk to investors, to say, articulate what you've written. People literally sit there silently and they get 1 minute to read it. And Once in a while, it comes up. People actually get upset with me about this. And they go, hey, actually, it's not fair. It's unrealistic. And I disagree. I think it's actually hyper realistic. Because in a real world where you have to distribute deal flow to a large network and to do it asynchronously without the ability to pitch one-to-one, these are the constraints that you're facing. You're either sending somebody to a deal page or sending an email. And this is all the mind share that you get. In this particular exercise, after the investors read somebody else's copywriting, they go to a poll. And in the poll, they're asked two questions. On a scale of 1 to 10, how well did you understand the company? That's the first question. The second question is, on a scale of 1 to 10, how interested are you in this company? And these were the results in one of the cohorts that I taught. There were 13 angel investors, each pitching a separate deal. And we got all the other 12 angel investors to rate these companies on these two questions. And so we bang it out very quickly, right? You get 1 minute to read, 1 minute to answer the poll question, and then we're off to the next deal, and we just crank through it. And these were the results that we got. Every single dot here represents the average score on one particular deal. The horizontal axis is the level of understanding. The vertical axis is the level of interest. Looking at this, eyeballing this, we have a 37% correlation between level of understanding and interest. So this is intuitive when you think about it, right? And this is like my argument of why, in principle, when we do deal marketing, we want to strip it down, make it super easy. That's number one. And secondly, focus on building the understanding first, because when you have that, there's a correlation with the level of interest in the deal. Okay, so this is our framework and the data and the thinking behind what drives this principle.